Hello and welcome to this quick tutorial. We're going to talk about how to use Portfolio Visualizer to run a Monte Carlo simulation and get to the expected probabilities of certain kinds of returns for this idea that Paul pitched today of investing $6,000 for 5 years and then letting it ride until retirement and then taking 5% withdrawals. So to do that, let me share here. We're going to share the Portfolio Visualizer screen. So if you haven't been to Portfolio Visualizer before, it's easy. Just open your browser and go to www.portfoliovisualizer, all one word.com. And you can see all of these wonderful tools here that are available for free for DIY investors. And today we're going to be using a Monte Carlo simulation tool, and it's called Financial Goals. So if we launch Financial Goals, we're going to do a single stage analysis, and we're going to use asset classes, and our initial deposit amount is going to be $6,000. Remember, we're doing $6,000 for 5 years. So we'll start with $6,000, and we're going to use the longest simulation possible, 75 years. We're going to use historical returns. And I like to use in the bootstrap model, I like to use a block of years where the analysis can grab 1 year or it can grab a sequence of 2 years, 3 years, up to 20 years. And I'm going to use circular bootstrapping on, which means it can loop from the last years to the early years. I think that this does a good job of grabbing sequences of returns from the past in addition to individual years. And we're going to rebalance annually, and I'm going to modify the intervals as well. So we're going to go custom. I want to see the worst case scenario, which is the 1 percentile. So I'm going to add that in there. So we've got 1 percentile is the worst case. And then you can think of 10th percentile as bad luck and 90th percentile as good luck. And then in return intervals, because we're going to be using an asset class that has high returns, I'm going to modify that as well. So we're going to use 8%, 10%, 12%, 13%, and 14%. So let's see how often we get those returns. That's basically what we're doing there. The asset class is US small cap value. So we can enter that down here. And then we have to set some financial goals. Well, we've got 6,000 deposit at the beginning. We need a little more funding here. So what we're going to do is we're going to contribute $6,000. And we're going to start that at the beginning, which will be at the end of year 1. We're going to do it annually, and we're going to have it repeat 4 times, because remember, we've started at the very beginning with an initial balance, and now we're going to add 4 annual contributions. And we're not going to inflation adjust it. And then we're going to take money out in retirement. So in retirement, we're going to do withdrawals, and we're going to do a percentage withdrawal of 5%. And since we're starting at age 21, we will be 65 in 44 years. I believe that's right. And we're going to do that 5% withdrawal annually, and it's going to repeat until the end. So with all of that entered, we can run the simulation and see what we get. Well, our allocation is 100% small cap value. That was expected. And we have our contributions and our withdrawals. And we can scroll down and we can see what the worst case scenarios were, the bad luck, the median or the 50th percentile, and the good luck. And perhaps more importantly, we can look at them on a graph. So we have these simulated portfolio balances, and we can switch it to a log scale so we can actually see what's going on. And we see that in these early years, since we're contributing, we got 1, 2, 3, 4, 5 contributions. That gets us, we start out at $6,000, then we're roughly 12. And at the end of our contributions, we're up to our, call it, $30,000 contributed, plus some gains, because there've been investment gains. And you can see how the outcomes go. It's kind of interesting. If you go out here to this bend right there, that bend is 44 years in. We started at 25 plus 44 is 65. Right at that bend, uh, that's the last year we contributed. Then the next year is our first year in retirement, and things have a shallower slope out here. And we can even inflation adjust this if we want, and we can look and we can see, like, right when we get to retirement, our 50th percentile, or the mid case scenario, is that we would have $1.4 million. Now, remember Daryl in his example that got us to a little bit less than $1 million real. He was using an assumption of 12% as his return. And then he took out 3% for inflation that got him down to a 9% return. Well, the history is actually better than that. The historical returns were closer to 14%. And that's why this mid number is higher. And even the worst case is a real balance of $200,000, which is pretty impressive. Because remember, we only put in $30,000. 5 times 6,000, we put in $30,000. And on a real basis, it was even a little bit less than that because inflation was eating away at the later contributions. So for a $30,000 initial real contribution, a little bit less, we end up with almost 7 times as much, 6 to 7 times as much in real spending power. We can scroll down a little farther and we can see the simulated cash flows. So remember, we started with 6,000 and then we added these, and these are in present dollars. So you can see the contributions of 58, 56, 53. Even in these years, inflation is eroding the value of the $6,000 we're putting in. And then you can come out and you can see the withdrawals. And you can see that we start out with a real, this is in present dollars, a real withdrawal of $70,000 a year. That's not bad. And by the time we reach our age 95, we're drawing out $245,000 real. Now, these are the median amounts. It'll move up and down. It's a variable kind of withdrawal rate because we're just taking a percentage of the portfolio. But what I showed in the podcast and what we can see up here on this other tab is we can see the expected returns. And so here are the annual return probabilities for different horizons. You've got 1 year, 3 years, 5 years, 10 years, 15 years, all the way out to, it doesn't go all the way to 75, it goes to 50 years. But you can see that the probability that we have made a gain is going up over time. And by the time you get to 15 years, you're almost 100%. And by the time you're at 20 years and beyond, you are at 100%. So the odds of somebody who uses this as a long-term investment strategy losing money is very small. Now, what are the odds that they would get what Daryl modeled his analysis on, the 12%? Well, at 1 year, there's about a 62% chance they would get that 12% or better. At 5 years, it's 58%. At 20 years, it's 66% roughly. And at 40 years, it's almost a 75% chance that you would have gotten the return that Daryl was suggesting or higher. What's the probability you would have gotten the historical geometric mean, or the compound annual growth rate of the asset class, of 14%? Well, that should be, and it is, right around 50%. Now, in the early years, it's a little bit higher, which is kind of interesting. And in the later years, it gets right around that 49%. So hopefully this gives you a better understanding of how you can use the Monte Carlo simulation tool to analyze a scenario using, in this case, it's the financial goals part of the website. One thing I want to show you, though, is if we rerun this, if we rerun the simulation, the numbers will change slightly. So let's look, for example, at this 50-year probability of getting the 14% return. It says 49.34. And if I rerun the simulation, and then we come back to that tab, now it's 49.37. So because this is a Monte Carlo simulation process and it's randomly grabbing these returns, it's going to produce a slightly different result every time you run it. And so you want to be careful about over interpreting the results. You want to be careful that what you're doing is you're looking at some meaningful and sizable difference. So would I say that I have high confidence that, for example, at 15 years here, you have a 49.14% chance of greater than 14% return, and that it couldn't be 48? No, I think it could be 48. It could be 50. I don't know. It could be 51. But would I say that you have a a very high probability of getting a positive return at 15 years? Absolutely. 99.98% of the time in the scenarios that were run, you got a positive return. So I'm not saying you need to have 100% to be confident in it, but just use some judgment in interpreting the results. I hope that's helpful to you. And as always, I wish you the best of luck in your investing. Take care. Bye.